friend of the pod.
He's credible because he's wearing a tie.
Yeah. Hey, Brian Armstrong. How are you doing, brother?
Brian Armstrong, you look fantastic.
Yeah, what are you, testifying today?
I'm doing great. It's not Montclair and it's not Laura Piana, but normally I just wear the black T-shirt and the hoodie, but when times like this, I got to go talk to media, policymakers, regulators, and it's a good time to spruce up the image.
This is a week to break out the tie.
Yeah.
Hey, listen, Men's Warehouse, it never looked better. You look great.
Thank you.
I see a red tie and I think fiscally responsible.
Now, if you don't know Brian Armstrong, he is the CEO of Coinbase. And basically, he's just going to talk about the issue, the meltdown with FTX, and to give his opinion on what's going on.
All right. I guess, Brian, just to kick it off, FTX in spectacular fashion blew up this week, and it's pretty gnarly. You run an exchange as well. What's your take on what happened with FTX? And then what is your position in terms of making sure your customers understand that Coinbase is not going to have a similar fate to all the other exchanges that seem to be blowing up every couple of months?
Yeah. Well, first of all, I think we were all shocked that somebody like Sam, who seemingly is so smart and capable, ended up in this situation where he appears to have done something quite unethical and illegal. So, my job right now this week has been to go out there and just help people understand that Coinbase is not like that. We've been pursuing a different strategy for the last 10 years. We're a public company. We're regulated. Our financial statements are audited. They can show that, customer funds are segregated. They're backed one-to-one. We're not investing customer assets without their explicit direction. And so that's been the first step, is just to make sure people understand that. But then after that, we need to kind of think about how we go forward as an industry here and both take a long-term perspective, make sure the good companies in this space aren't allowing one or two bad actors to kind of mess it up for everybody else. And then it feeds into the whole regulatory story too, because companies like Coinbase are already regulated, but we're regulated like a traditional financial service business. But we don't have clarity about the crypto-specific regulations, like what's a commodity, what's a security. And that lack of regulatory clarity, I believe, has pushed a lot of this business offshore to these less regulated exchanges. That's part of what caused the blow up today. They were based in the Bahamas, and there's not sophisticated financial regulators overseeing what they were doing.
Brian, there's a lot to unpack, but maybe we can just take a step back, and for the uninitiated, or for the person who's only been just following this very superficially, can you just, in a nutshell, explain what happened?
Yeah, so my understanding is, and again, this is from people I've talked to, and I spoke with Sam and CZ briefly during this, but I didn't get details from them. I got it from other people.
You spoke to them this week?
Yeah, this was all going down. I spoke to Sam about, he was trying to raise emergency financing and things like that. And I spoke to CZ about why he was considering buying the asset. I thought it was a bad idea. But my understanding of what happened at this point, and again, I don't have all the facts, this is just my understanding, is that FTX was in a position where they had this market maker, Alameda, that was investing in risky things. And that's fine. Like market makers, hedge funds, they're designed to take more risk. It appears at this point that back during the last shakeup in the crypto industry where, Terra Luna and Voyager and Celsius and Three Arrows went under, it appears that Alameda took a big loss at that time as well. They may have even been underwater. And instead of just saying, hey, this hedge fund's going to blow up too, which would have been unfortunate. People would have, Sam would have lost money. It's embarrassing, but it's not illegal for a hedge fund to blow up. It happens with some regularity. Instead of just letting it blow up, it seems like at this point, he took customer funds.
But you have to explain, he owns both. That's for the people that may not understand that.
Right.
So it's a related party.
He owns his own exchange called FTX, and he owns his own hedge fund called Alameda,
which operates inside of FTX as well as in other places, right? But again, Alameda seems to have blown up. Sorry, Brian, back to you.
Yeah, so it seems they had this solvency issue, and instead of just letting it blow up, Sam basically said, hey, we have a bunch of customer assets over here at FTX, or he somehow basically made a loan from FTX into Alameda to try to prop it up. I don't know why he did that. That's the moment in my mind where he crossed the line into probably committing fraud. And I think he probably lied to users, lied to investors, and he went around and tried to bail out these different companies like Voyager and BlockFi and to sort of prop up this thing. And maybe he thought he could trade his way out of it or something. I'm not sure, but that seems to be where the mistake was made.
Well, definitely the mistake was made there because it blew up in his face.
Brian, can I ask one question, which I think will help frame the contagion risk set of questions that everyone's having. When people have an asset, we all talk about customer deposits and customer assets held at these exchanges, but those assets and those deposits are very often some form of coin. I have some amount of Bitcoin, some amount of Ether, some amount of something else. Is it the case that there is an assumption of total asset value that's held in a portfolio of coins that doesn't necessarily match the individual user's accounts? And then when one coin goes down in value nominally to dollars, that the whole value of the portfolio goes down, and now you can't actually make the customers whole. So in the statements that have been made by these guys and other exchanges that we have enough liquidity to cover customers' accounts, that the assumption might be we have enough liquidity if you assume the current market price for a whole bunch of different coins. But then if one coin tanks, the total liquidity tanks, and they don't actually have it matched up correctly because now the customer account value didn't go down as much as the exchange's total asset value. Does that make sense?
It does. And
is that part of the contagion risk that's going on here? Is that they're not matched truly between customer accounts and the exchange's holding of coins?
so not exactly. Okay, so if you're a regulated financial service business, but you're not a bank, we're regulated as a trust company, a money transmitter, et cetera. You're required to hold customer assets one for one, denominated in the asset. So in other words, if you say the customer has one Bitcoin, you have to hold one Bitcoin. If they say they have $100, you have to hold $100. And so that's the case with Coinbase. You don't have to take our word for it, by the way. You can look at our audited public financial statements as a public company with an independent, Big Four accounting firm who went to go verify all of that. And that's what various custodians and exchanges, that's what they all should be doing. By the way, if you're regulated as a bank, you can actually go invest some of those, but there's very strict regulation around that and capital requirements and whatnot. And we're not a bank. So we hold one-to-one. Now, if you're an investment fund or a hedge fund or something like that, then you can try to take positions in different coins and different assets, and they could go up and they could go down. You may lose your investors' money, but there's no such thing as the customer assets being involved in that. There needs to be clear segregation of those customer funds and from what an investment fund would be or corporate funds. And that's where they got in trouble. They basically commingled customer funds with their hedge fund.
Classic fraud.
Yeah. Can you explain the contagion, by the way, just so we can, because everyone's been talking about the contagion and understanding what's next. So that's what I just want to, because I think people are going to be asking that a lot this weekend.
Yeah, so I do think there is some contagion risk here. I think there's other firms that had, first of all, there's firms that had money just sitting in FTX, and that's now going through bankruptcy court. So that's been bad. I mean, Multicoin came out publicly and said that they had.
A lot of firms have gone under because FTX has collapsed, because they thought that FTX was a good investment, but it turns out, Sam took a bigger risk than he was able to handle, and now that's why we're in this position.
10% of their portfolio sorted on FTX. There's other firms that Alameda may have had loans with, and those firms are probably struggling. I don't want to say who, but we have received a couple of inbound calls from other people trying to get emergency financing. There's people who may have just totally different from FTX and Alameda. They may have just had their own portfolio that they took margin or leverage on to buy crypto, and now as the prices have come down a little bit, they're getting stopped out. So that's all been very challenging. And I again, just for the sake of clarity, I should say that Coinbase did not have any material exposure to Alameda FTX or FTT token.
Can we just talk about this issue of customer deposits? Because this is really the crux of the issue from a legal standpoint, right? I mean, I remember when I was doing PayPal like 22 years ago, and the company was like 6 months away from running out of money. I remember the lawyers told us really clearly, you cannot use customer deposits to fund the operating expenses of your business. In other words, if this business ends up going bankrupt, you'll still have all the customer money there and they'll be able to get it back. And, it was really clear, like, hey, if you use customer funds to pay for the burn of the business, to operate the business, that is a do not pass go directly to jail type offense. And so, like, that's really the heart of this. Now, I read in...
And I think a lot of people are expecting the FTX CEO, Sam, to be arrested because of what he has done.
Some articles covering this, that the way it worked is that Alameda had a bunch of these FTT or these FTX tokens called FTT. And they basically use that as like a marker, as collateral. So that they basically borrowed, what is it, like $6 billion of customer funds from FTX. And then they use their own token to then as collateral. So
to backstop it.
Yeah, exactly. And then what happened is apparently like CZ got wind of this and he owned a whole bunch of these tokens and he signaled that he was going to dump it and the price basically went down. And so now all of a sudden the collateral for the customer loans was insufficient. And then there was a run on the bank. And
by the way, this happens in the public markets a lot as well. So like when you see heavily shorted names or when you know that certain hedge funds are on the brink, other hedge funds will go in and essentially force a margin call and a stop out, because then it's what causes all of these runs. And if you look actually inside of GameStop, the reason why you got all this gamification in the GameStop equity and a bunch of these other names was in part because of this dynamic. Folks that are highly levered, folks that don't have the right matching of risk. And what happens is they're solvent but illiquid. And then if you run the instrument into the ground, they both become insolvent and illiquid all at the same time, and the whole thing explodes. So, Brian, the question is, now that we know what happened, which is all of these crazy inter-party related transactions and, you know, all of this stuff seems very illegal. There was a bankruptcy filing today, and up until today, it seemed like this issue was really about FTX International and Alameda, and it didn't touch FTX US, which for a long time tried to position itself as, you know, well run and regulated as Coinbase. To be, you know, they tried to say that. But now, if you look inside the Wall Street Journal, all the articles say that this is actually FTX Group, so the whole thing seems to be imperiled. Can you just help us explain that? Because now that's a lot of US people that were following the rules, thinking that this thing was matched one-to-one, that may be also affected.
Yeah. So, look, I don't know who inside FTX's and its orbit of companies actually knew that the fraud had been taking place. It would not surprise me. I have no idea, to be honest, but it would not surprise me if FTX US people and employees had no idea that this was happening. I'm imagining if Sam was doing, when he started doing this, he probably wanted to keep it to a very small group. Otherwise, this is the kind of thing that leaks and the whole thing blows up. Now, that being said, I don't necessarily think FTX US is worth anything as a business right now because of the brand being so tainted. And there probably was not great separation of these entities in the sense of, you know, like, did they have truly separate boards and beneficial owners and governance? And Sam seems to have, you know, it appears that FTX didn't really have a CFO or maybe even like a real board or anything like that. And so it's hard for me to imagine.
Sam is the board.
We found on Reddit, there was an article that appeared that said that the head of compliance at FTX was also the head of compliance at a poker site called Ultimate Bet, which in the 2010s did this exact thing, apparently. Some version of this where they went in and they...
Smells like a fraud.
Looked at hole cards of poker players, and then a few employees inside the business would basically play against these folks, knowing what the hole cards were, ran this cheat, stole millions of dollars. Somehow that person found a way to be head of compliance at FTX.
Yeah.
10 years later, which is incredible. But back to this question. So now what happens now is you have the international business and the US business and Alameda Research all rolled up into this one frozen entity, right? With now regulators having to... So do you know what happens in a process like this? Like, is it that the DOJ and the SEC get priority, or is there some international monetary, like who unwinds all of this? How do people get their money back, if at all?
Yeah, so I'm not an expert at this, but my high level understanding is that the bankruptcy courts will essentially, and I believe they filed bankruptcy in the US, which is an interesting thing. I didn't know why they did that versus Bahamas. But anyway, the bankruptcy court will basically go through and try to find any assets of value. So, I mean, they still have some tokens and value. They have a venture portfolio. I think Sam owned 9% of Robinhood. There's various things that they may own. And then they'll kind of auction those off to various bidders on distressed assets and then try to distribute those funds to the customers. I don't know the exact process beyond that.
Yeah, I agree. I read one report that Sam still had $1 billion. Well, honestly, he shouldn't have any money. He should be broken and broke and on his way to jail, because you have to find a way to give the people their money back.
So,
I mean, if you remember, the Madoff wind down took many years. And for years, he was trying to find assets, and then he found a market, sold them. There's the trustee. I think he's still active. And then, tried to redistribute the funds. Obviously, so many more customers here than there was with Madoff, but it can be a very long and winding process to identify all the assets, then run the market sale process on them, then figure out who gets what first, and then distribute.
There was an interesting thing that Larry Summers did, I think, for Bloomberg, where he was asked whether this was Lehman or Enron. And he said, it seems more like an Enron than it is a Lehman. And Brian, I'm just curious how you think about it. Like, is this sort of a fraud perpetuated by a group of executives to essentially take advantage of a situation? Or do you think that this is more like a Lehman situation, which is a well-run business, I guess, that just, got caught in a liquidity trap?
I think my guess is it's a little more like Enron in the sense that, yes, they were over-levered and that kind of thing, but the minute that they moved customer funds in some way, shape, or form to backstop the hedge fund, that was, in my mind, fraud. And, that's more like Enron.
Do you think now that we have to open the gates on regulation, like the whole point of crypto in some ways was, trust nobody. And, decentralization is the key. But here what we see is a lot of people were tricked into trusting FTX and having their deposits there. And it was a centralized exchange, which caused all these problems. So it's like, it almost violates the principles of what the whole product market fit was supposed to be. So what should sort of the observer expect, and what do you expect as a business in terms of how governments now react to all of this?
Yeah. Well, I think it's really important to distinguish between the centralized players in crypto, which are custodians, exchanges, et cetera. Coinbase has a big business there. And the decentralized players, which are, self-custodial wallets, DeFi protocols, Web3, that whole world. So the centralized players should be regulated. And today they're regulated already like kind of traditional financial service businesses, but they don't have the regulation clear when it comes to the crypto aspects. So for instance, in the US, we actually don't still have clarity about what is a commodity, what's a security, which one should CFTC regulate versus SEC, that kind of thing. And that lack of regulatory clarity, and frankly, the climate of regulation by enforcement, the negative rhetoric from Chair Gensler in particular, has created this sort of chilling effect in the US that has pushed a lot of that centralized actors' activity offshore. In fact, 95% of the trading volume in crypto is now outside the United States, and it's come down a lot since the beginning of this year even. Now, the decentralized players, self-custodial wallets, DeFi, Web3, this is where crypto really has an opportunity to make a more fair and free and transparent system, because you can go look at any smart contract to see exactly what it's doing. Anybody can audit the code. If you have a self-custodial wallet, you can just trust yourself. You don't have to trust any other intermediary out there. And that's where you get true decentralization. And I think that's actually, now, those areas still have a couple of their own challenges. Sometimes people will lose their password or their phone and they'll lose their own money. So if you're trusting yourself, you still have to trust, that you're going to do that piece correctly. But there's a lot of good things we can do there around making social recovery mechanisms and MPC wallets and things like that.
We remember just a couple of months ago, Gary Gensler started saying, hey, these things are all securities. And you went and visited the SEC a couple of years ago, or you tried to. They wouldn't meet with you. You were very public. You did a tweet storm. We talked about this on my other pod, that, hey, we want to meet. We want to talk about that. Now we're still in a position where the SEC's position is these are all securities, which means anything that's trading, it would have to be limited to accredited investors, et cetera. What should the United States do here? And how close are we to getting clarity? Because I know you're trying to talk to the SEC directly about, can we just get some clarity here? Can people buy these tokens or not? What is the status of, are they tokens? Are they securities, or are they not here in the United States?
Yeah. So luckily, since then, we have had a lot of productive dialogue with both the SEC and the CFTC and Treasury and all kinds of people in Congress. And I do think the U.S. is making some steps in the right direction. There was a bill going through Congress recently called the DCCPA, or the Stabenow-Boozman bill, although it's having some challenges now, frankly, due to this FTX blowup, because SBF was one of the people sort of pushing that bill forward. But regardless of that, the sort of system that we should have is there should be a clear designation between what is a crypto commodity, and that can be regulated by the CFTC, and what is a crypto security. Now, this is one of those legal, and by the way, what is also a stable coin and artwork and other things that are not any of those things. The challenge lies in that there's kind of a fuzzy line between what is a commodity and what is a security. And a lot of this law is based around the Howey test, which says a security is an investment in a common enterprise with an expectation of profit. And so it's basically a point-based system. And in the absence of really getting a clear list between the CFTC and the SEC are in this turf battle, I would love it if they could basically put out a list, get their heads together and put out a list. Hey, CFTC is going to do these, SEC is going to do these. A bunch maybe are in the middle. Let's let the courts figure that out or whatever. But that just hasn't happened, and it's a missed opportunity in the U.S.
So if the Howey test is not perfect, given the dynamic nature of cryptocurrencies and all the innovation, if Brian Armstrong was going to say, hey, this is in the best interest of Americans, balancing some amount of security and safety for people making bets on this currency and allowing innovation, what would you say is the best definition, the best way for us to regulate crypto coins? Putting NFTs aside, putting DAOs aside, just specifically.
Yeah, actually, coins. Jason, hold on. Let me just tweak your question.
Sure, build on it.
Because we should switch to SBF as well and just talk about the person. But to me, it seems the whole issue, if you come back, like what is the first string that you pulled that unraveled the sweater, was the fact that these tokens were created out of thin air. They had no meaningful value. Somebody prescribed a value, and all of a sudden, everybody else in the economy all of a sudden said, yeah, I'll take that as collateral. Look, you cannot do that in the regular world. I can't call JP Morgan and say, I've invented this thing. It's called a share in XYZ, and I'd like you to margin loan, give me a loan against it. So, Brian, explain, there's a ton of these tokens that have been engineered, right? And there's been a ton of these tokens that have been sold. So what should people do that own these things thinking that there was going to be some safety or value or, how do you think about all of these tokens that could be as basically as fragile and shitty and worthless as FTT?
Yeah, well, there is this concept of like an exchange token, and there's a couple other firms out there that have them, and that's something we haven't done. And I think you're right. Like the actual utility of those things is a little questionable. And so if someone's going to sort of mark those up on a low supply and then a low float, and then somehow leverage that's going to get yourself into trouble. But look, I don't want to throw out the entire concept of people creating tokens. I think there's actually a lot of good stuff there. And it comes down to this idea of if you're trying to raise money for your company and through a token, that's fine. That should be a security. And there should be a regulated way to do that in the US. Like go register it with the SEC, let it trade on broker dealers. That's what we've been wanting to do for a long time. And the SEC is taking their time getting there. They don't, Gensler, to be honest, he doesn't seem that excited about the idea of this whole industry existing. And so anyway, but it should exist, and it should be happening in a regulated way. So if people want to issue a token that's raising money for a company, let's regulate it as a security.
So that when you're a big investor and you have a stake in one area and you're losing a lot of money in that area, you have to sell elsewhere, and you sell what you can sell. So you sell where you have liquidity. Does this FTX story have the potential to create wider losses in more assets and more traditional assets? I know you're expecting a settlement tomorrow in the lawsuit between the Securities and Exchange Commission and Ripple. The SEC's filing from 2020 alleged that Ripple Labs and two of its executives raised over $1.3 billion through an unregistered digital securities offering. This is a separate case, but your thoughts on whether any of this has the potential to take down other markets like the stock market?
Absolutely, Maria. Well, it goes to your first point. When contagion happens, it's because everything is cross-collateralized, and the system at large, based on credit, is so fragile. So we do see Bitcoin drawing down, and we can see other assets drawing down as people liquidate in order to cover their margins and their shorts. And so I think what's important to know about the SEC and Ripple, and it'll be interesting to see what the verdict will be, is that the SEC charged Ripple with violating securities law and argues that it passes the Howey test. It says that it's a common enterprise, an investment contract and a common enterprise. And the big thing I want people to remember, no matter what happens tomorrow, is right now you can go to Twitter or Google and you can find Ripple's CEO. And Ripple is the largest holder of its own token. Sound familiar? So if there's a CEO, if there's a company, if there's a pre-mine, a foundation, an IC.
All right, now, so let's take a look at what's going on with Ripple. Ripple today started on the 16th, started its 6th annual Ripple Swell. As you can see by the CEO there, it's underway. And they're announced nearly 40 payout markets are live for ODL. So I clicked on the links already. So let's take a look and see what's going on with that. So today, Ripple, the leader in enterprise blockchain and crypto solutions around, announced ODL customers momentum globally in new regions, Africa, Argentina, and Belgium and Israel, as well as current fiat base RippleNet customers upgrading to ODL in Australia, Brazil, Singapore, the UAE, the UK, and the US. That is awesome. So let's scroll down to here. 2020 has been an unprecedented year for crypto's usage in enterprise use cases, despite market turmoil, of course. Of course, you know that the crypto market went from $3 trillion to, I think, $800 billion at the time of this video. So a lot of people lost a lot of money. The end goal for Ripple, as you can see here, has always been to help enterprises, rather large financial institutions or local payment service providers, move money around the world the way information does today. With ODL's expansion into nearly 40 payout markets around the world, representing 90% of the FX market, the proof is in the pudding. Business can rely on crypto to deliver the speed, efficiency, security, and scalability required to complement our formerly purely fiat financial infrastructure at low cost. Absolutely. And that was from the Senior Vice President Brooks. So let's look at here as well. As Ripple's products reach significant growth and scale in 2022, we continue to invent and deliver solutions to sustainably grow and offer best-in-class experience on behalf of our customers. Absolutely. And that is why Ripple will continue to be the one that, out of all the cryptos, they will continue to be the one that makes it. And that's what I believe. As you can see here, they will continue to go. But because of that, let's see the price of Ripple at the moment. So it's currently at 37 cents. So let's look at the chart, see where it's been. I think it really has like a sideway trend. Right, it looks more like a little sideway trend there. So at the high on 7-day was almost 40 cents, and then the low was 32 cents. 32 cents, and then it has currently at 37 cents. So it hasn't moved much, but definitely it is because of the case that is going on. We're expecting a verdict, settlement, I believe, some information next year. March timeframe is what everyone is hoping when the settlement will be over with versus the SEC. So that is it for now. Thank you again for watching. I'll see you in the next video.